Okay, on to introducing our next speaker, Charles Dumas. You have a short bio in your materials, so I'll keep it rather short. Mr. Dumas is the chairman and chief economist at Lombard Street Research, a leading macroeconomic forecasting consultancy. Earlier, he was an investment banker and a journalist as well. He's written several books analyzing the developments of the current financial crisis, and today he's going to share with us his forecasts for 2012. Charles Dumas.
Thank you very much, Lizzie. And I'm going to go a little bit beyond 2012 because the 2012 part is hard landing. I understand you've had quite a dose of gloom over the last couple of days. And I can't say that going outside is going to make you feel any better, because the weather's fairly bad out there. Normally I sort of cheer people up with the thought the sun's shining. But whereas the outlook for 2012 is pretty awful, the longer term outlook, at least for the United States, we think is quite good. And so the title of my new book is The American Phoenix. Obviously it's very obtainable outside. It's changed the business card, charge a high price on Wall Street. And the Phoenix, of course, rises from the ashes. 2012 is the ashes. Now, the other piece of good news is that I'm not going to talk about Europe. So that saves some of the gloomier things that one might have to say, although obviously I'll answer questions about Europe should they arise. So moving right along, in fact, we'll start from the world, if you like, because it says global 2012 hard landing. And what I've got here is world savings. And I think this is a very important chart indeed, because a lot of people think that the debt crisis was caused by too much debt. And of course the reason they think that is because they're right. But what we have to remember is that too much debt was a result of too little saving in certain countries, namely most obviously the United States, but also Britain, Club Med, I think is a collective term for the current Euro delinquents, and Australia and a few others. So, you know, if that's the case, how come the world savings rate in 2007 and also the year before and the year after was the highest on record, as you can see from this chart? And highest on record actually by quite a large margin, and you have to go back to 1980 to come anywhere close. The answer, of course, is very well known, namely that there was corresponding to the too much saving, too little saving rather in the US and around about. There was much too much saving, grossly excessive saving in most obviously China, but also Japan, Germany, the countries around Germany, and the Asian tigers. And so there was a story of imbalances. But and the basic point is that since interest rates were really low, and very low, especially low in real terms, all the way through the middle of the last decade, what was really happening was that the savings were chasing investments rather than the other way around. If there's a big apple harvest, then the number of apples being sold goes up and the price goes down. So when the volume of a commodity goes up and the price is going down, it's because it's supply driven. When, on the other hand, the volume goes up and it's demand driven, of course, the price has to go up a long way in order to elicit the extra supply. So you can tell which it was, and since the real price of money went down through the last decade, it was savings driving investment. And what happened, and driving actually not just investment, but dissaving, which is the point. You know, all this money came flooding out of these countries and drove up asset prices, and of course it was tempting to borrow in order to buy assets, and so people did. And the result was that the savings rate in the US went down, and that used up quite a lot of it, although the world savings rate has to be equal by the world investment rate. So dissaving in the Anglo-Saxon countries mostly only used up a portion of the excess saving. So what happened? Well, as we all know, the insufficient saving in the Anglo-Saxon countries led to too much debt, particularly in the household sector, which led to too much debt by a very large margin. So the financial collapse occurred. And once people weren't able to borrow anymore, which was ready from the 2007 onwards, the basic excess of saving expressed itself in insufficient demand. Because of course, if people are saving, there's insufficient spending to offset it, then the economy spirals down, and that's what happened. So what we saw in 2008, 2009 was not just a financial crisis, but also a simple Keynesian relapse of the economy. Now, you'll be interested to note that the savings rate in the world this year, according to the IMF projections, is right back up there where it was in 2007. So we should ring a warning bell. We've added a new source of imbalance to the imbalance between countries, and that is the very severe imbalance between private sector surplus here of saving over investment, and government deficit. Now, if we'd had a healthy recovery from the crisis, a healthy recovery would of course require more saving in countries like the US and Britain and private men in order to pay down debts at the same time as there's recovery. So you have a growth and more saving. But of course, the elements of growth are consumers, governments, business spending and exports in the economy, and so if the consumer and government is not allowed to spend because we want to let saving go up, then it has to be led by investment or exports, and investment is unlikely to be all that forthcoming after a recession. So it follows that for a healthy recovery in the world at large, there had to be reduced net imports, actually, like net exports in the United States and in the other deficit countries. That meant that the surpluses of the surplus countries had to be going down too, because, unfortunately, it would be very nice if there was a nice big Martian economy out there and we could export our surplus to Mars, but sadly it's a rather undeveloped economy, and so we have to balance it inside the Earth, or round and about the Earth, should we say, on the surface of the Earth. And what this means is that the surplus countries had to reduce their net exports, which meant that they had to be led by consumption. But the broad brush story is that the Chinese tried to do a bit, at least on the investment side, not so much on consumption, but because they also maintained a structurally undervalued exchange rate, it rapidly got into an inflation problem, and that's going to be quite a big theme that I'll talk to you about in a moment. The Japanese would have done something about stimulating consumption, but more or less proved that they can't. And the Germans could have done something, but wouldn't. So, because they think it's right for us all to be running surpluses. In other words, the German economic approach is based on the assumption there is a large economy in Mars which can run a deficit. So that was what happened. So there was no improvement in the surplus reduction, that is, surplus countries, and we had to have instead an unhealthy recovery, and the unhealthy recovery basically meant that we didn't increase the saving in the deficit countries at all. We really shifted the dis-saving from the private sector to the business sector, to the government sector, in the form of the government deficits that you can see in this chart. So that was Mr. Draghi being shot for having lowered interest rates. Pretty outrageous. Anyhow, so you had these government deficits to stimulate the economy, and at the same time effectively to transfer the debt from the private sector, particularly the household sector, to the government sector. You can see how the private sector, this is the blue line, is the private sector of the advanced countries. This is in total, this is West Europe, total West Europe, US, Canada, Japan, and Australia, and Australasia, if you like, combined. So it's a large portion of the world. And then you throw in the surpluses that continue to be owned in China and the tigers, you get the black line, and that more or less corresponds to the deficit on the other side. Because of course the rest of the world, which is India, Brazil, and so forth, hardly can run a deficit equal to 8% of these guys' GDP. So that was that. Now the deficit last year was a bit better than the year before, 8% of GDP, and the IMF forecast, which this is derived from, is that that deficit will be moving from 8% to less than 4% in 2013. So suddenly everything's going to get better. Now you'll appreciate that that improvement of the forecast, the deficit that the IMF is talking about, means less government dis-saving, which in the sort of global sense means more saving. And so it comes as no surprise that in this gross savings chart you have the savings rate shooting off to the stratosphere, really, over the next few years in the annual forecast. But of course, savings equals investment, by definition, and follows that this forecast can only be true if investment is suddenly going to roll off north as well. And yet we have a situation where in China, even last year, we don't have this year's numbers yet, but even last year in China, investment was 49% of GDP, which is a sort of all-time high and a ludicrous level. So the idea that this suddenly it's going to switch off into infinity is really absurd. So the basic problem here is that this reduction of the government deficits on a global scale in advanced countries is instituting a huge Keynesian inflation. And frankly, there's very little offset to it in the offing, as it were. Because, let's think about the normal offsets in a country where you have a fiscal deflation, always assuming that fiscal deflation doesn't do what it might do, which is deflate the economy. And the offsets typically are either monetary policy or domestic supply side flexibility or the external side. And monetary policy, unfortunately, is not really available on any kind of scale because interest rates are already close to zero. So we're not in a position where the monetary offset can come into play and soften the blow of a fiscal tightening, which is projected to be very severe. Because I mentioned that they plan to go from 8% of GDP last year to under 4% in 2013. But you'll notice that the 2011 entry on this chart, which is like this year, only shows a very small improvement to about 7.5% of GDP. So this is a sort of St. Augustine style improvement of the public deficit. Lord, make me virtuous, but not yet. Well, the virtue is due to come into play next year in the form of more than 2% reduction of this government deficit in the IMF's projections and indeed in the projections of various countries, not getting to the most obvious one, which is the United States at the moment. We all know about the severe fiscal deflation that's going on even in the reasonably healthy countries in Europe, like Germany and France, and savage deflation in Club Med, pretty vigorous deflation projects in Britain. So, you know, it's a global phenomenon. Because these guys represent more than 2/3 of the world economy in these advanced countries. Now, as far as the supply side goes, of course, there could well be some improvements. One improvement that we would expect is a reduction of the price of oil, which will improve the real income. But unfortunately, we think that's going to happen as a result of the recession that we're forecasting, not as a means of preventing it. So the supply side does indeed kick in to help recovery, but it doesn't actually prevent the deflation achieving a recession. So the other side, which I mentioned, of course, was the external side, which is to say everyone not advanced countries, and they are thoroughly dominated by the progress of China, which I'm going to talk about quite a bit. And the point is that, of course, China is deflating too, because they have a serious inflation problem. And so they are basically restraining their economy and slowing it down. So the main external side is not very helpful. most of the trade of these countries, of course, is with one another. The advanced countries as a whole have exports from the area, as opposed to within one another, that are only 7% of GDP, and imports likewise. So the leakage, in any case, into less imports rather than less product is small. But in this case, of course, it's going to be offset by less exports from China. So basically speaking, you have a huge fiscal tightening with virtually no mitigating factors. And as we know, as we're seeing in countries like Greece, in the most conspicuous fashion, of course, but others to a lesser extent, when you have a fiscal deflation, it reduces people's reduces spending, therefore reduces people's income. Those people getting less income also spend less. And there's another multiplier, which is on the exacerbating side, as opposed to the mitigating side, when there is a fiscal deflation. So the basic global story is that the path of virtue, as it's expressed or as it's popularly regarded by people's usage, namely less government deficit, is going to stop the economy dead in its tracks next year. And actually, I don't see any way of avoiding that, except, of course, reducing the deficits. This is just a little propaganda chart I put in there to cheer you up. It just shows you that countries that don't save so much actually grow faster, vice versa, so you don't imagine that saving is some really good thing. It's just a reminder to everyone to be utilitarian rather than moralistic. And so that's the basic problem. At least it is part of the basic problem. The other part of the basic problem is the US side of things. So this is a little bit of the spaghetti chart, and I'm sorry about it, but actually it's proved quite useful to have to go back 55 years, whatever it is. But if you just look at the right-hand side, which is where we are now, you've got government deficit 10% of GDP in the United States, and the business sector has its saving, which is to say retained profit and depreciation, about 5% of GDP ahead of its investment, which is capital spending inventory. The household sector has saving, which is about 2% of GDP ahead of its housing investment. And so the two together are about 7% of GDP, the private sector, slightly less than the 8% measure for the advanced countries. And then there's a little over 3%, which is foreigner surplus, as described in this chart, which is the current account deficit with the sign change. Current account deficit, or current account balance, of course, is the current account viewed from the US side, and from the foreigner side, it has a sign change, so it's a surplus. And those three add up to the 10% deficit on the negative side. So, you know, if you came into this economy, and actually you'd say the same with Greece for that matter, you'd say, okay, chaps, you need to devalue and tighten your belt. That's what the IMF says to everyone when they get brought in. And the reason is that it works. And that's what America needed to do, needs to do, and it's what Greece, of course, needs to do, and can't do in Europe. Well, the problem for the United States is that the main exchange rate is set in Beijing. And so they're stuck. They weren't able to devalue quite the way they should have. So they had to carry on running these deficits. And then what happens? Well, the Chinese economy in purchasing power terms is nearly 3/4 of the United States. Whereas when they locked in their exchange rate in 1994, it was about 1/5 of the United States. So, you know, it's suddenly become much more obtrusive. As I already demonstrated, the Chinese economy is seriously undervalued. So the Chinese, through locking their yuan on the dollar, have created a dollar zone. And the dollar zone is one in which you have an undervalued piece, China, and an overvalued piece called the United States. You call it China, right? And the basic arrangement here is that once the distortion and the destabilization is over, and people realize where we are, then that essentially the crisis which we have, then the undervalued piece of a currency zone tends to get inflation, and the overvalued piece tends to get deflation. And by August 2010, 2010, last year, Chinese had inflation of 3.5%. Compared to -2% the year before. So the inflation rate had changed 5.5 percentage points in the space of actually 13 months. Extraordinary, very, very extraordinary. And the US, meantime, was facing the prospect of deflation. Now, the problem for China in this creating this zone is they thought they were into a sort of win-win situation, which they could be undervalued forever, which, by the way, happens not to be such a clever policy, but that's what they thought. But actually, the thing is that the Americans control the issuance of the main currency of the zone, namely the dollar. So they said, okay, well that's fine, but we don't particularly want that. We're going for me this time. There we go. Right. Yeah, so anyway, Bernanke said, yeah, as a matter of fact, we don't particularly want deflation in the United States, just because you guys have lashed your yuan onto our dollar, so we're going to just pour out a whole lot of dollars. So he did, in the form of QE2, and the Chinese got a big dose of inflation as a result. The whole thing was shifted towards a mixture of inflation in America, inflation in China, deflation in America, towards all inflation in China. And so the Chinese inflation rate went up to 6 or 7%, CPI, 7 or 8% for the main elements of Chinese expenditures. I should not have considered spending, but because of the exports. So all of a sudden the Chinese had an inflation problem. And as a result of that Chinese inflation problem, in a funny kind of way, the Americans achieved the adjustment they needed. Because there was also a small revaluation of the yuan against the dollar, and so that 7 or 8% for the goods index of China and the investment goods index of exports in the yuan meant about 10% for the same things in dollar terms. And at the same time, in our equity service, we find that the Chinese profit margin is shrinking a bit, which indicates to us, and supported by other evidence, that the labour costs are rising faster in China now than prices, which means that the unit labour costs in dollar terms in China are rising by more than 10% a year, and in yuan terms, by close to 10% a year. But of course, in the United States, unit labour costs have been flat falling for the last few years. So all of a sudden, the Chinese actually have appreciated. They've just done it through the back door of inflation. They'd have done much better, of course, to have let the exchange rate float and let it go up. Then they'd at least have the benefit of lower inflation in the context of a higher real exchange rate. Instead, they've got a higher real exchange rate through the mechanism of inflation. And we're talking about an adjustment rate of more than 10% a year in terms of labour costs. And this has been going on now for about 18 months, and the rate of differential between the two is narrowing at the moment, because Chinese export prices are coming under pressure. But basically, by the early to mid next year, there will have been a 20% adjustment over the course of about 2 years or a little more of China versus the United States, in the United States favour. So that's the good news in terms of global development, and of course in terms of the ultimate US recovery. In the US is finally in a position where it can it's achieved the devaluation it needed. The problem is that it devalued by loosening its belt. Whereas what it was supposed to do was devalue and tighten its belt. So the whole thing was done the wrong way around because of this yuan dollar peg. And so the United States then has to move on to stage 2, which is indeed to tighten its belt. And that's the stage we're getting into now, and that gets us right back to the theme, which is that we're going into a fiscal inflation. And that's what tightening the belt means when we start off at 10% of the EPFC. And you can see from this chart that when the emphasis on the part of Obama, almost as much as the Republicans, is placed on cuts in government spending, you can sort of see why from this chart. It's government spending, which is to got itself out of line in recent couple of years, and so they're going to have to cut it, and that's what they're doing. So we had a big fiasco really in August about this, but if you look at the numbers in the United States for GDP, you'll find that real government spending for both the federal and the state and local were going down sharply in the first and second quarters of this year. the third quarter, the federal went up a little bit, mostly because of random flows of military spending. The non-military federal went down in the third quarter, and state and local continued down. And so all of that was then, and we're just about to get into what we are now in October, November, which is the fourth quarter, and October is the beginning of the US fiscal year. It runs from October to September. So the cuts that were being implemented as a result of the August deficit fiasco are kicking in right now in the fourth quarter. So America's already moved into a significant fiscal deflation in the fourth quarter, which I might say is already in the first half of this year, which is the main reason why growth was surprisingly disappointing in the first half of this year. Third quarter was an exception, partly, as I say, because government spending temporarily rose a bit, but also because some of this sort of Arab Spring and Japanese disaster effects on the second quarter unwound in the third quarter, so you have some favourable effects. Now there's another sort of random element here, which is not totally random, which is connected to the loosening of the belt. The QE2 was accompanied, or shortly followed, by significant fiscal loosening for 2011 only. One part of it was payroll tax easing of 2 percentage points for this year only, which is equivalent to 1% disposable. The other part of it was 100% year one write-offs for capital spending, provided installation first by the end of this year. And the result is that we had a very strong development in the third quarter of business investment, 17% annual rate of growth. And we expect continued strength of that in the fourth quarter, and even within the consumer spending, which people remarked on the extraordinary drop of the US savings ratio to 3.6%. I think that's because the consumer spending was heavily boosted in August and September, especially by cars. And cars, of course, seem like consumer spending, you've got a statistician, but a lot of people's point of view, they're actually an investment. And you get fleet sales and so on and so forth, and quite a lot of the sorting out of how much was business spending and how much was consumer spending goes after the event when they've got more information. So my guess is that actually quite a large portion of the surge of consumer spending in the third quarter was also, in fact, to do with this 100% first year allowance, although it was also reflecting the fact that the Japanese components were back on the stream in the third quarter, and the labor production was satisfying. So we've had quite a nice little third quarter, which in fact we were forecasting, and seems to have gone against the expectations. A lot of people got a panic in August, deficit fiasco, but the basic reason they got the panic remains in place, namely that deflation coming down the pike is very severe indeed. I already mentioned that the fourth quarter will start to see some big cuts in spending, but in the fourth quarter you will at least still see the CapEx coming through these 100% year one write-offs, and you may see a little bit of consumer spending. So, in the first quarter of next year, it's all systems reverse. You've got, first of all, the substantial cuts in capital spending coming ongoing, and you've got this so-called super committee, which is supposed to produce some results this month in terms of $1.5 trillion new spending cuts for the United States. But of course, we all know that it's their job to disagree with one another because it's an election year coming up, and neither side wants to be seen as lost. So they'll disagree, and the fallback provision will come into place, which is substantial further cuts. Then, on top of that, the payroll tax reverts to its, under current law, unless it was changed in law, reverts to its previous level at the end of the year, which means that 1% of disposable income gets taken out of incomes from January onwards. So between the fourth quarter and first quarter, 1% of disposable income is taken out of income. But of course, the way the Americans present their GDP numbers, which is an annual rate, that means it's 4% of an annual rate in the first quarter of this year, of next year. So there's a huge inflation impact coming through for consumer spending in the first quarter of next year. And then lastly, you've got this capital spending, which is swollen at the moment by bunching into this year in order to take advantage of the tax break, which means that not only is the level at the end of this year elevated by that, but in addition, the amount of spending in the first part of next year is going to be lessened because a lot of it's already happened, which is bunched into this year, so you've got a double whammy on the downside for CapEx too. So, so both government, consumer, and capital spending, there's now to be a pretty violent downswing in the first part of next year. So it really is a sort of a structural deflation. Now, Mr. Obama has said, can we please extend the payroll tax cut and deepen it? And of course, it's difficult. The Republicans will usually reject his associated press with infrastructure spending, but it's difficult for them to reject tax cuts because they say that they like tax cuts. So, what will they do? Well, we can take it as read, I think, that the main objective of the Republicans in the House of Representatives will not be to secure the re-election of Mr. Obama. So it follows that they will be trying to spike his guns in one form or another. But if they have to give him something on the payroll tax front, then probably they will only do so if they can take something away by having more spending cuts. So you get to the same place in terms of deflation, but maybe spread out over the year rather than in the first quarter. So whichever way you cut the cake of this, you've got the US side of this huge fiscal deflation kicking in over the next 6 months, and we don't see really how that could be avoided. So that's the first part of the story, and it's a pretty unpleasant part. That brings us to, well, let's have a little think about the medium term of the United States before we get to China. The medium term is that as well as having finally achieved devaluation so that the Americans are now much more competitive, and therefore this capital spending growth will probably revive once they've got over this kind of up-down effect arising from the tax break this year. As well as that, you've got therefore import substitution coming through the United States. We've also got a peculiar demographic effect, namely that the first wave of baby boomers in America was born in 1946, and the number of Americans born at age 65 last year was 2.6 million. Next year is going to be 3.3 million. So 700,000 different, which is by itself 0.5% of the labour force. So this means that there are all these people who have just reached retirement age, but unfortunately they can't afford to retire because they haven't saved anything for 20 years. They thought they were going to sell their big house and downsize and use the proceeds to buy a pension, but unfortunately the housing market downsized, their price fallen before they were selling, so they can't retire. So they're going to have to carry on working. That means it's a tough life for the kids getting a job, which means that there's more labour force than the conventional analysis suggests. Which means that there's downward pressure on wages and salaries. Now this, of course, is quite good news for medium-term investment out of the US in terms of profit ratios resuming their strength. So that is something that is very important. In addition, if you've got baby boomers tending to save their social security checks, because that's why they're coming on working, savings rate going up, and at the same time the profit ratio going up, so the disabled business is going up. That means that if you go back to my 7% of GDP, the private sector surplus, you may well see that dip next year in recession. But the positive side of that, the two savings rates are both going to be trying to improve over the medium term for the next 3 to 5 years. But and whereas we certainly expect that capital spending to be quite strong, we think that surplus could easily remain in the 4 to 5% region in the medium term. But at the same time, if the US is going to get its public finances under control, let's say with the net debt of the public sector now nearly 80% of GDP, they want to stop it at 100% of GDP, let's say, which is where it is today. Then to stop it at 100%, you have to get the government deficit down to equal the growth rate of nominal GDP. That way the incremental debt is equal to the incremental GDP. Numerator is nominal GDP. So that's fine, but the nominal GDP is only growing about 4 or 5%, about 4 or 5%, 2 to 2.5% each for inflation. So all of a sudden, in the out years, we've got this prospect of 4 to 5% private sector surplus and 4 to 5% government sector deficit, which means the current account is in balance. which means that the historic improvement of other people's balance payments by exporting to the United States is over. That long, where's it gone? There we are. That red line, which back in the 50s and 60s was below zero because the United States had a surplus and got to a US deficit of 6% of GDP in the middle of the last decade. That red line is going back towards zero. What that means is that the guys who have basically fed their export-led growth off this, which was Germany in the 50s and 60s, followed by Japan, followed by Korea, followed by the Asian tigers, and most recently China, are going to be sucking wind. Technical language. And so the export-led growth game is up. And what that means, we think, is that China's got a problem. Because as well as exports being the source of their growth, they are easily the biggest, of course, of those various people ending up with China, Japan and Germany, relative to the United States and relative to the world at large. And they are also the one left standing when the music stops. And you can just look at the extraordinary ratios we've got in this country. I mean, consumption I'm showing here, personal and government together, is 40 to 48% of GDP, 48 to 49% of GDP. So the saving rate is over 50% of GDP. Fixed investment in inventories is 49% of GDP, of which fixed investment is 46%. So, and consumer spending is only about 33 or 34% of GDP, so about 2/3 of that consumption. So you've got an economy where both exports, which are 40% of GDP nearly, and exports were less than 40% now. They were 40% cheating part of it. This measure of exports, of course, excludes some exports of services. Exports are larger, about the same size as consumer spending, and investment is a lot larger than consumer spending. There's never been an economy remotely like this in the past. Japan, in the early 70s, was running an investment ratio of about 36 to 38% of GDP, and with the collapse of Bretton Woods, it collapsed because their exchange rate had to go up, and it did, as did the German, and the Japanese were not able to cater with that, and so after a while, the waste from this export price inflation, which is showing on this chart. And so that which I mentioned earlier. So where we got in China with a situation where they desperately need, as a matter of urgency, what they declared in their policy, namely a switch towards consumption-led growth. The problem is that this is the sort of reverse of chaps with girls, if you like. The mouth says yes, 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 and the eyes say no, no, no. That is to say, they keep saying, yeah, of course we want to raise our consumption ratio, but they don't actually do anything that would cause that to happen. Because, you see, for example, having blundered into appreciations to inflation rather than appreciation by letting the currency go up, and confronted with this inflation, they haven't raised their interest rates to match to bring it under control. They've tried to do it by administrative means. The real interest rates are negative, which means that the ordinary Chinese nest egg is reducing in value because of the inflation, which means they have to save more, i.e. consume less. And at the same time, of course, businesses having a negative real cost of capital are encouraged to invest more rather than less. So the actual incentives in place are all towards protecting the state-owned enterprises and protecting the exporters and encouraging more investment and more saving and less consumption. So the actual switch that needs to be made is not being made in real policy terms. And actually, if you think about it, it's not very surprising because the way China works is that the thing is led by exports and investment, and consumption occurs with sort of trickling down, if you like, of income into consumers who then spend something. But consumer incomes in total after tax are only about 50% of GDP, and they save about 15% of GDP and spend 35% of consumption. So they're only going to get consumer spending going if that 50% goes up. You're not going to get it going because they can save less. Because if exports and investment are going to slow down, then the trickle down will be weaker. The last thing they're likely to do is say, oh, well, just because go out there and save less. They're going to say, hey, I'm scared, I'm going to save more. And so the only way to get it going is if there is a voluntary acceptance of very substantially reduced flow of income in the sort of top-down corporate state nexus of China. And that's exactly what one sees no sign of whatever, because that's exactly what these low interest rates are designed to do, is to protect the income and the current status of state-owned enterprises, state-owned banks, and the exports. So I don't actually see the Chinese have taken the steps necessary. Now, there are a lot of other things one can say about the Chinese supply side, which are very important, but that's the gist of the argument. They don't actually have a structural policy in place to achieve the declared goal of increasing business. Since we think that the export decade is up, it follows that the Chinese growth rate over the future years is going to be much weaker than it has been in the past, and probably weaker than we were projecting. And it's the United States which has achieved its devaluation, which will be able to recover on the basis of a flexible supply side, falling oil prices, import substitution, and capital spending. So our advice to you, if you're investors out there, is to wait a year, because the recession is bound to take its toll on all the stock markets, and then put your money in US stocks rather than the emerging markets. Thank you very much.